So I'd say the key thing, the most important thing that successful business leaders are doing that I've seen, or when I've enjoyed some level of success, is when we work in complementary areas.
Welcome to Multifamily Insights. I'm your host, John Casman, and I want to thank you for joining us for another great episode. Listen, if you're an avid listener to the show, I'd love to hear from you. Leave us a rating and review. Give us some honest feedback so we can make this show work harder for your investing goals. We also want to hear what you love about the show, if that helps as well. And listen, if you haven't done so, this is your first time listening, be sure to hit that subscribe button so you don't miss an episode. We've got a great show today. We're going to be talking to Ray Hightower. They say you're the average of the 5 people you spend the most time with. So if you want to grow as a multifamily investor, you have to spend more time with other multifamily investors. And an easy way to do that is to join our apartment investing mastermind group today. Just go to casmancapital.com and click on the mastermind button. Now, as a part of this group, you'll get access to expert trainings, group coaching calls, industry news and updates, as well as all of our webinars and workshops, including our 3-hour workshop on raising capital. Again, if you want to be around other multifamily investors that can help you scale your portfolio today and grow your network, make sure you're a part of the Apartment Investing Mastermind. Just go to casmancapital.com and click on the Mastermind button today. Ray Hightower is a commercial real estate investor and tech company founder operating in the state of Arizona in the USA. Now, Hightower started and ran his technology company for over 2 decades before selling the company and launching Bridgetown Partners. Now, Bridgetown buys commercial real estate in Arizona, Tennessee, and Texas with a special focus on 50 to 150 unit multifamily properties. Let's welcome to the show, Ray Hightower.
Thank you, John. Thanks for having me here, man.
Absolutely, Ray. It's great to have you on the show. Great to talk to you today. I went over your bio at a very high level. Why don't you take 2 minutes and fill in some of those gaps?
Sure. In a nutshell, my background is in technology. I have a computer science degree from the University of Illinois. I spent time in corporate America with a couple of Fortune 500 firms. I was in commercial real estate as a broker back when I was in my late 20s, did that for a while. And after that experience, I went back into technology and started my tech company. I ran that for 21 years in Chicago, sold it, and now I'm in multifamily, buying in Arizona, Tennessee, and Texas.
I love it, man. So you mentioned that you kind of were in the tech space, got into commercial real estate, went back to the tech space with your own company, and now you're back to commercial real estate. So we got your
Yes,
two loves,
yes,
right?
yeah,
Tech and real estate.
yeah.
Talk to me about those two worlds. Like, where do you see the synergies and the things that are similar, where you keep kind of going back and forth between those worlds?
You know what's funny? There are people who I only know or only know me in one world or the other, and they ask, "Well, how did you happen to be in that world?" I said, "Well, I've never left either one. I've always had a passion and an interest in both of them. I've always had an interest in technology, going back to the days when, my parents brought my brother and me erector sets, and we were getting into all the technology of that. So that's why we both went to engineering school." And then I've always been interested in real estate. That goes back probably to my 20s when I was hanging out with some friends in Hawaii. We put our money together and took a bunch of red-eye flights to get to Hawaii very cheaply, and we piled on top of each other in hotel rooms and explored Hawaii and learned that a lot of people who did well in Hawaii did so in real estate. So that's when I decided I wanted to go in a commercial real estate brokerage. Did not do as a commercial real estate broker back when I was in my 20s. I did okay. I closed vacant land, restaurants, apartments, industrial property, a couple of random commercial deals, and one single family house. But I was bitten by the bug then and had the opportunity to restart in technology. That was at the beginning of the internet. I started that company in 1994 and took off from there. So yeah, it's just been exciting. The common denominator between those two industries, I would say, is the understand. There's a technical knowledge that you need to have in both cases. There's technology you need to understand in real estate. Everything from HVAC systems to underwriting to how to raise capital. Those can be very technical subjects. And of course, in what we call the technology world, in the software world, you need to know how to write software or build networks, depending on what it is we're doing for the client.
No, I appreciate you sharing that, understanding kind of how those two worlds converge for you. in the technical aspects, because there certainly are right ways and wrong ways of doing things, and things either work or they don't work. So you got to understand
Yes, yes.
what those components are. So I like that. Let's talk a little bit about what you're up to today, right? You talked about, investing in, 50 to 150 units with Bridgetown. What are
Yes.
the assets? What kind of assets are you looking at, generally speaking?
Yeah. Generally, like you said, from my bio, 50 to 150 units, really we've set our buy box more currently at 75 units plus, because
Okay.
we've looked at larger assets too. We have assets in Phoenix and in Tucson and Sierra Vista, Arizona, and are looking really in Nashville, in Tennessee, and Brownsville, San Antonio in Texas. So we try to go into markets where there are three big things happening: job growth, income growth, population growth. So those are the things we're looking for. That's what brought me to Arizona. I was living in California a few years ago, looking at real estate deals there that did not make sense. And I ended up doing road trips to Phoenix, between LA and Phoenix. And one day I woke up and said, why am I burning up all this money on the highway and on hotels and Airbnbs? Why not just live here? Wonderful decision, because 4 months after I got here, I was in my first deal with partners, 93 units in Tucson, and then we've just continued to build up from that.
Yeah, I love that. That's a great way to look at it. You talked about the three things you're looking for are markets where there's job growth, income growth, and population growth.
Yes, sir.
And those things really help us drive rent growth, which is one of the things we're really paying attention to, right? Is
Yes.
ultimately we want to make money. And in order to do that, there has to be enough demand for that. When you look at
Mhm.
those factors, do you compare that to like construction starts or development or absorption? Like, give me a little bit of context on like how you take those three metrics and also look at the overall supply and demand aspect.
Yeah, sure. I know you really do have to look at things like construction starts and absorption if you're doing Class A properties, because that's what you're really competing against. And your listeners probably know about the different classes A, B, and C of properties. A, of course, are the pristine, newly developed properties that are so clean you could eat butter pecan ice cream off of the floor. I'm exaggerating a little bit, but there you definitely want to look at your starts, your construction starts, because that's what you're competing against. The newer properties, most developers are building Class A properties. And I heard a joke when someone said that if you want to build a Class B property, build a Class A and wait 20 years. That's how you get a Class B, right? So the newer properties compete more against a Class A. And for that reason, we've decided to go in more into Class B and C properties, what's called workforce housing, as you know. The people who live there are people who go to work, come home, and they're fine. They work the jobs that keep our economy going. And without those, where would everyone else be, right? That's the foundation. So those are the people we provide for. And if you like, I can go into reasons why we chose B and C as opposed to A. Whichever direction you want to go in
Well,
with that.
I appreciate you sharing that because I think that's very helpful, particularly for some of the markets you called out, right? Phoenix, Tucson,
Yes.
like a lot of these markets, as we're recording this now, they're seeing some pullback from,
Yep.
kind of the growth that has happened over the last 3 to 5 years. So talk to me more about kind of the state of those markets and
Mhm.
particularly how that plays out in the B and C class apartment investing space.
Oh, yes. You said the word pullback, and that's exactly what's happening. When I first got here, I moved to Arizona in 2020. We were in the middle of not just double digit rent growth, but 20% rent growth, 22% rent growth per
Record
year for
setting.
a few years.
Yeah.
Yeah, record setting rent
Yeah.
growth. And by comparison, nationally, what's the average rent growth like? Closer to 5%, 3 to
Yeah. It was
5%,
five or
somewhere in
six.
there,
Yeah.
right? And in fact, even when we're underwriting, even if we've gone through a year of 20 or 22% rent growth, we would never write that into our underwriting. We would only do 3% because that's all you can predict moving forward. If you already have that 20% and it's in the can, you've already got it. Yeah, all right, that's reality. You've already achieved that, but you could never expect to achieve that in the future. What really drove that kind of rent growth was the people moving to Arizona from California. I'm one of them. I moved from California to Arizona, and even though we were in the middle of that rent growth, what I saw is that I was able to get much bigger living space for a lower price, even though Phoenix was in the middle of that rent growth. And Tucson was on the same trajectory in the same direction, only maybe with a slope that was a little bit more level, closer to like 9-10% in there, but still an increase in year over year rent growth right there. So that is driven largely by people who want to move from an expensive state to a less expensive state. People are always looking for opportunities, not just looking for lower expenses, but looking for job opportunities. In Arizona, you've got employers like the Taiwan Semiconductor Manufacturing Company, TSMC. They make the chips that are in all of our iPhones, iPads, in our computers, in our cars, in our toasters, and our washing machines. And they are a big employer. TSMC, they were planning to build a $12 billion plant here in Phoenix. They upped their budget from $12 billion to $40 billion. And that's a huge facility within the city limits here in Phoenix, in northern Phoenix. And then in Tucson, you have a bunch of employers too. You have Fort Huachuca, that's just south of Tucson. You have the Davis Monthan Air Force Base there, military. And near those military bases, you have defense contractors like Raytheon and Lockheed Martin and all of the people that support them. And across the board, in cities between Phoenix and Tucson, you have employers like Lucid, the electric car manufacturer, and you have battery suppliers that supply to companies like Lucid, and you have companies that make chemicals and other tools and devices that supply to TSMC and Lucid, and to Google and Facebook and Netflix and all of the other tech companies that are here. So it's fantastic. I feel like I gave you a really long answer to that question.
Yeah, but I love the breakdown though, right? You just talked about some of the companies that are there, how they're expanding. You talked about TSMC going from a budgeted $12 million or $12 billion
Yes.
development to $40 billion. And just understanding like what that growth means. And the thing that I want to kind of harp in on is you said people moving from expensive states or from expensive areas to less expensive areas. And I think what happens sometimes is people, we have a country that's become so politicized that
Mm,
people get fired up and they say red states and blue states, and I ignore that. Like, don't
yeah.
worry too much about that. However, I think that the message behind that is what you got at, right? Some of these states have become very, very expensive with the different taxes and everything else that's going on.
Yes.
Where when you look at it, you're like, well, if I were to live in this state or in this city, it's more affordable. I'm getting more space. Like it's a
Mm-hmm.
better value exchange. So take the politics aside. Most people are just going to look at their own situation and make an investment. And that's what these companies are doing. So the part of the
Yes.
reason these companies are growing is they're saying, hey, the cost for us to do business in the state of Illinois, the state of California, it's too expensive. We're not getting any breaks, like they're taxing us for extra stuff. But these states over here, or these cities over here, they're going to provide some tax breaks so they don't have the same tax laws. It's going to be easier for us to do business. And then people are going to follow those jobs. So that's what's happening. Obviously,
Yes.
why it's happening starts getting into the politics. But if you remove that and just follow what's actually happening, that's why people are looking at places like Phoenix or Arizona to move and to invest in, because they're more favorable when it comes to the taxation. I want to bring
Mm,
that back to what you were talking about, Ray, going from kind of the A class apartments to maybe the B and C class apartments, because
mm-hmm.
for most of the people we're talking about, that's probably going to be more in the A class space, or people are going to go out there and buy a single family home, not necessarily those individuals who are kind of the backbone of America, right? Those blue collar workers, the workforce housing. They're usually not picking up and moving state to state because of tax laws. So for that individual and what we're seeing kind of in the economy right now, how are you seeing that play out in the B and C class apartment space?
Yeah, yeah. It's all about jobs. Can they get jobs? Jobs, that's the number one driver of value in our business. Can they find jobs, and are there job opportunities? And people living in the B and C class apartments, just like everybody else, they're looking for opportunity. They want to raise their families and, have some fun with their families, and, go to work and take care of business just like, everybody else. And they're the backbone. And as long as they have jobs. As long as all of us have jobs, those of us who are entrepreneurs, we're creating jobs, right? But as long as, and people in A-class properties need to have jobs as well. Many times you have people who are, people in A-class are folks who could go into a house, buy a house if they wanted to, but they choose not to for whatever reason. Maybe they are only going to be in Phoenix for a year. It doesn't make sense to buy a house if you're only going to be in a community for a year. You might be a traveling engineer or a traveling nurse or traveling physician or architect or any of those, right? So those are the people going to A-class or some, yeah, that's typically what happens here. But the big driver, really, to answer your question, the big driver is jobs and job opportunity.
So I know when I look at the national reports, or at least when they send it out and they talk about rent growth, Phoenix, as we talked about before, Phoenix was seeing 20% plus rent growth,
Mm-hmm.
2020, 2021. I know that that's turned in the other direction. Are you seeing that play out in actuality when it comes to the B and C class apartments?
Yeah, it's flattening out a bit. It's flattening out, and you may or may not see an actual decrease in the rental number, what's being offered. But what we also look at is concessions. Are they offering half a month rents free when you sign the lease? You're seeing more of that. Or are they offering a full month free? Or are they offering some other concession? Are they, people offer different things. Sometimes they'll offer I know in a lot of C-class properties, they'll offer a big screen TV or something like that. So you'll see it more in the form of concessions. And then when we do our underwriting, that's going to be a line item, that's an expense item there.
No, I appreciate that. And I think it's just helpful for people to understand like how it manifests itself in reality versus maybe just looking at a report.
Oh,
You're in
yes.
multiple markets, right? You talked about Arizona, Tennessee, Texas, some similarities in those markets, right? You talked about the,
Yes.
income growth, job growth, population growth. When you're
Mm-hmm.
looking at deals today, like where are you seeing opportunities? Are you still investing and looking at deals the same way you were, last year, 2 years ago, or has that philosophy or that approach changed at all?
Ooh, it's changed. Even I spent a lot of time, like you, I spent a lot of time talking to wealthy people who want to stay wealthy because they're prospective investors or they are investors, investors in current deals or investors in future deals. And there's a lot of concern, whereas there was more push to, yeah, let's go ahead, let's close this deal, let's get it. I know it's not exactly getting the return they were expecting right now, but we can see that we're on this trajectory of 22% rent growth, so we're going to get it next year, whatever. Now we're seeing more conservatism, I would say. People are noticing that there are rental concessions and that rents are not on that rocket ship anymore. And when I say people, I mean investors, because our investors are very sophisticated. The people who are limited partners in our deals are going out, in many cases, secret shopping properties themselves, or they're reading the industry newsletters and following what's going on with interest rates themselves. So they see all the factors that go into making an investment work. And we're seeing more caution in investing. We're seeing more people who want to sit on the sidelines. And that's the difference between now and, say, maybe 18 or 24 months ago.
How does that change the types of deals you do today?
Well, we have to make sure we're very conservative too, because ultimately we are fiduciaries. I look at it as, we as syndicators, we are fiduciaries over our investors' money. We have to care for that money as if it were our own, or even better than that. I like to look at it this way. There's something an investor of mine, a friend and investor of mine, said to me once. He said, Ray, when I invest with you, it's kind of like I'm a Boy Scout leader also. I'm an assistant scoutmaster in a Boy Scout troop, and he knows that I take scouts on trips, along with other adults. We get together and take scouts on trips, camping trips. And in the same way the parents trust their sons with us on a camping trip, this investor is entrusting their money with us on an investing trip. What is the deal? What is a syndication deal but a trip for their money through the capital X process, the CapEx process, and then ultimately turning it into something where that money grows and you can return it to the investor in on a higher level. Return to them more money than they gave to you.
Yeah, man, I love that analogy. I'm picturing you out there in the woods with money wrapped up and walking on the trails with you and making sure it comes back with some friends, right?
That's a cartoon. I should get
I
someone to
know
draw
it
that
is. I
cartoon.
know.
That's a
I
great
see it
image,
in my
man.
head. It's beautiful, right?
Yeah,
I love it,
wow.
man. I love it. So to that point, Ray, like we know obviously the times have shifted a little bit here. As you're looking to expand and going forward here, the kind of deals you're doing today, are you looking more at cash flow at all? Are you looking at more in place stuff, or just technically speaking, like what are some of the things that you've adjusted on your side?
Cash flow first. Cash flow is very, very important to us because appreciation, you don't know that you have appreciation until you've, gone full cycle and sold the property. But cash flow, you have immediate feedback, or at least feedback every 30 days. Every time the rent comes in, you have immediate feedback. So that's a big factor that we're looking at. And cash flow will get you through. Even if the property, for whatever reason, depreciates in value, if you have cash flow, you can still make distributions to your investors and keep folks happy.
Yeah, one of the favorite lines, and I don't remember who told me this or where I heard it from, but I absolutely stole it. So I wish I could give them credit. But they told me that, cash flow is king because it allows you to control the exit. And the value of a property really only matters on 2 days: the day you buy it and the
Mm,
day you sell it. And cash flow gives you the ability to pick that second day. If you don't
yes.
have cash flow, you kind of lose options. So to your point, I think folks who maybe focus more on that appreciation play and maybe have dismissed cash flow. That fundamental is definitely important today, and more so than it's been in a long time. But really important to make sure that we are all paying attention to cash flow in these deals. Ray,
Yes.
I know you sit with a lot of investors, right? You've got your ROI Clear show as well. Talk to me a little bit more about launching that show and some of the guests and information that you get.
Oh, that has been a joy. Launching ROIClear has been a total joy because of all the people we get to talk to. And I'm a fan of business, not just real estate, but business in general. So we bring on board business leaders who are in a variety of industries. They could be auto manufacturing or marketing, or they could be commercial real estate. They could be residential real estate, doing fix and flips, that type of thing. They could be developers or, real estate or software developers. They could be engineers, electrical engineers, or industrial engineers across the board. So we have a wide variety of people. One thing they all have in common is at ROIClear, we believe very strongly in capitalism, and we believe that when capitalism is practiced right, everybody wins, because that capitalism is about taking something of very little value or no value and increasing its value so it's valuable to someone else, and then they want to pay you for it. And when we have that system going, everybody wins. It's one economic system where everybody can win and everyone can benefit by pumping more value into the system. So ROIClear is all about capitalism, and we interview a lot of very successful capitalists there.
No, I love it. Listen, we're going to make sure we link to ROI Clear in the show notes so people can check
Thank
that
you.
out. Ray, I think one thing that has always stood out to me, we had a chance to meet in person a couple years back at a conference,
Mm-hmm.
is just, how you think about things. And you talked about, your investors, your LPs being very sophisticated. And I love, having guys who really understand the business and guys and gals who, take the time, learn, research, understand all these things, because I think it allows them to be empowered and to have more knowledge about their own investing strategy. And it's not to say you're going to know everything, right? You got to get to a point
Mm-hmm.
and
Mm-hmm.
pull the trigger and make some steps and learn a little bit more about yourself and your investing style. How would you say that you crafted that over the years? When you first kind of came in from, I know you're a commercial broker earlier, but as you started as, I believe, an LP and kind of graduated and moved on to launching your own firm, how did you kind of grow and learn and develop kind of your investing style and strategy?
Yeah, that's a good question. And I consider myself still growing. I'm always growing, always learning from people like you. And what I try to do, number one, is I try to surround myself with people who know things that I don't know. When I first met you, you were a successful syndicator. We met at that conference in Colorado right before COVID. That was wonderful. Learning from you, learning from other people that I met at that event, and learning from my partners, my co-GPs, people who I'm in deals with. Every time also, when I have chosen to put LP money into a deal, it's been with someone that I felt I could learn from and eventually partner with. It's always been with someone who is operating in a market where I knew I wanted to eventually invest as a GP so I could learn from them and perhaps partner with them. And that's worked out really well. So that's how I do that. And then I read a lot of books. I devour books. I love books. That is those are big things for me. So that's how I grow, really by surrounding myself with people who are really sharp, and we all want to share information with each other, and also devouring books, and that's what I do.
I think there's a couple of key insights there. So really there are three takeaways for me. One is networking, which
Mm-hmm.
people hear us talk about all the time. One is reading, which is again very, knowledgeable and makes sense. The third is you're partnering, and a little different than networking because you are investing, but it's not just about the money. You're partnering with people who you want to build a relationship with, who are in markets that you want to be in, where this is almost like an opportunity to continue to learn and continue to expand that education. So you're putting your money to work to develop these relationships with people and to get a better sense of that market, that investing style, that person, so that you can potentially partner in the future. So I think
Mm-hmm.
it's really important for people to get a sense of what they really want to get out of an investment. Sometimes it is just the ROI and it's just the return. Sometimes
Mm-hmm.
it is, the ability to prove out some points or to build a relationship with that operator. So if you're going to do that, make sure you're talking to these people and that these individuals are able to help you or are open to helping you and talking to you and looking to build on those kind of connections. But I think it's a really great way to approach it, right? Is talk to people in general, build networks, read, certainly do your own education, whether that's listen to podcasts, meetups, whatever it is, however you learn, do that.
Mm-hmm.
But then lastly, partner with people that you can expand with. Don't make it
Mm-hmm.
transactional where you're going to invest one time in one deal, get your
Yes.
10% return, whatever it is, and you're done. Try to invest with people that you can build relationships with and you continue to grow with over time. That's going to
Mm-hmm.
benefit you much more. Ray,
Yes.
for folks who want to learn more about you, ROIClear, they can check out your website, rayhightower.com.
Yes.
What information will they find when they get to that website?
Yeah. RayHightower.com is my blog. You will see business articles, you will see technology articles, but more importantly, you'll see links to all of the things that my team and I are doing. You'll see a link to ROIClear, which is our podcast. You'll see a link to Bridgetown Partners, which is our syndication arm. And you'll also see a link to azmm.org, which is a mastermind that we have for multifamily investors in Arizona. We're the Arizona Multifamily Mastermind Group.
I love it. Well, we'll make sure we link to that in our show notes. Ray,
Thank you.
right now we're going to go to our round of insights. Are you ready?
Okay. Yes, I am.
All right. Give me a failure or an apparent failure that sets you up for later success.
A failure or apparent failure that set me up for later success. I would say when I was in commercial real estate 30 years ago, and I got as my father likes to say, got my head whooped. And from that, I learned how to negotiate, I learned how to sell, and that set me up for success in my technology company.
Love it. All right. Give me a digital or mobile resource you recommend for your business.
Digital or mobile resource that I recommend for my business. My goodness, I love ChatGPT. I would say, if you had asked me a few years ago, I would say Google, because you can find almost anything via Google, but I really enjoy ChatGPT because you'll get answers that are almost conversational. So I would look at ChatGPT.
All right. You said you're an avid reader. You love to devour books. So give me the book you've recommended or gifted the most in the last year.
In the last year, oh wow, easily. 10X is Easier Than 2X by Dan Sullivan and Benjamin Hardy. And the only other books that could come close to that are two of those authors' other books, Who Not How.
And the gap in the gain.
Yes, yeah, and The Gap in the Gain, yes. And the other one, Be Your Future Self Now, that was by Benjamin Hardy alone. So that collection of books, oh my goodness, I devour those over and over again, and I love discussing them.
Yeah, I just finished 10X is Easier Than 2X maybe a couple months ago, and it's great read for sure. Appreciate that.
Yes.
All right, give me a daily habit that helps you stay focused on your goals.
I work out. When I wake up, first I pray, and then I do some sort of workout. I'll either ride my bike like I rode my bike this morning, or I'll run. but that's something I do every day. So for me, it's either bike riding, running, martial arts. Those are the things that I do to work out. And I pray every day, and I review my vision boards and my goals every day. So those are the habits that I engage in every day consistently.
Ray, you talked about on ROIClear, you talked to business leaders, entrepreneurs, all sorts of different investors who are focused on the bottom line. Give me your number one insight for driving the ROI.
Number one insight for driving the ROI, it really comes down to the people you have on your team. And this gets into the books 10X is easier than 2X and Who Not How. It gets into that because what you want to do is focus on that area that you're very, very good at and bring other people on your team that are good in their areas, perhaps areas where you're not as good. And I am fortunate that I work with teams right now where, you know, I can focus on what I do and I interact with them and they're focused on what they do. And I love it because they're good in areas where maybe I'm not as strong, and, you know, vice versa. And we complement each other well. So I'd say the key thing, the most important thing that successful business leaders are doing that I've seen, or when I've enjoyed some level of success, is when we work in complementary areas.
I love it. All right, let's lighten the mood. You are out there in Arizona. Give me your favorite place to grab a bite to eat.
Oh my goodness. You know where I go all the time? There's a place called, funny name restaurant. Well, there's a couple of places. A place where I went to breakfast yesterday is a place called First Watch. I love that spot. I love, they have these multigrain pancakes that are awesome. So I'd go to First Watch. They have multiple locations in and around Arizona. Another spot that I enjoy for lunch is called Flower Child. Great vegetables. I'm a very big fan of vegetables. And so I want to make sure I always get vegetables. So those are two places that I enjoy here in Arizona.
I love it, man. Great options there. I love it. Both of those. I'm a big fan of First Watch myself. So you just made me hungry, and I think I'm about to check them out this weekend. So,
okay, do that.
Ray,
Do that.
Ray, always great talking to you, man. I appreciate learning a little bit more about your background and kind of that background in both tech and commercial real estate, you know, focusing on kind of building out your company, Bridgetown, and the investment strategy you use. Understanding those three factors, right? We're looking for investment areas and locations where there's income growth, there's job growth, and then there's business growth, right? Did I do it right?
Population growth. Yeah.
Population growth. There you go.
Yeah.
Population growth.
Yeah.
I was like, that doesn't sound right.
That's all right. Business
growth.
growth follows from those. So it's not, I wouldn't say it's wrong. It simply follows. It's
There
compatible.
you go.
Yeah.
But focusing on those areas, right? Where's the growth at? And then you're focused on B and C class assets, right? You don't want to compete with all the new construction products. You want to really focus more on that workforce housing, the folks who are looking for a great place to rent. That's kind of where you're focused. And you're looking at these opportunities today, and obviously focus a little bit more on cash flow because that's going to give you more flexibility into the future. Again, for folks that want to learn more, check out some of the resources you have on your website. They can go to RayHightower.com. Again, that's RayHightower.com. Ray, thanks again for being a great guest and coming on Multifamily Insights. We look forward to staying in touch with you. Hope you have a great day.
Thank you, John, for having me. Thank you very much.